Hey, what's up, everybody? This is Leroy, and welcome to my channel, 40 and Broke. We're all about getting out of debt, saving, investing, and getting our finances under control so we can live the life we've always dreamed of, because that's what it's all about, living the life we've always dreamed of. So as you can see, I'm here with Guillermo from Finance ABCs, and we are going to talk options today. I know absolutely nothing about options, so I figured this would be a great video to break down the complete basics. So here we go.
Yeah, we're going to talk about what options are, how you can make money with them, and important terms. We'll go through a few terms that are important to know to understand what options are. And then we're going to talk about some of the risks and the downsides of it. So let's go. What are options? Options, they really just contracts. They're contracts between two people. The guy that buys the option and the guy that sells it. Now, what does an option do? You can either have one to buy shares of an underlying stock or to sell them. It's either or. You can't do both. But if you have an option to buy, then that option gives the buyer of the holder of the option the ability to buy the underlying stock at a set price for a defined period of time. And the option that gives you the ability to buy 100 shares. It's a block of 100 shares, no less. There's no fractional options yet, but that will be an innovation that may be coming in the future. But so it's if you buy the option, then you have to pay a premium to the seller. And options are traded on exchanges, so you have some protections. You don't have the credit risk of, well, if the guy that bought the option doesn't perform, then what happens? No, the exchange is going to protect you. So they'll require a margin, they'll require collateral from the counterparty. So that's pretty well worked out. So so if you buy the option, you can buy a call option. That means it's an option to buy shares in the future, or you can buy a put option, which gives you the ability to sell shares in the future.
Okay.
So suppose you have, yeah.
I don't mean to interrupt you, but before we get going too far, like I said, I know nothing about options. So when you say that you have the obligation to buy or sell, or you have the contract that you can buy or sell, but you don't have the obligation. So what happens if you decide, you say, okay, I want to buy this option, but then later on you're just like, you know what? No, I don't want to buy the option. Well, how does that work?
Okay, the guy that buys the option has the choice, has the alternative. Let's put an example. If you buy an option to buy the underlying at a set price, let's talk about Coca-Cola. Coca-Cola is trading at $57 a share. If you buy an option to buy Coca-Cola at 60, okay, for 1 month period, and Coca-Cola goes to 65 in this period, then it's going to be to your advantage to exercise that, because you hold the option, so you could buy it at 60 and then sell it immediately in the market at 65. But if Coca-Cola instead stays around 57, which is now what it's trading at, then you hold that option. You're not going to buy it at 60 because you could buy it in the market at 57. You see? Yep. So that's the thing. If you buy the option, then you have the alternative to buy or not. But if you sell the option, if you're the counterparty, then you have the obligation to sell it to the person if he exercises it. You see the difference?
So with that example, let's say you said it's selling at 57. So, and they're blocks of 100, correct? It's 100, technically 100 shares.
That will be $5,700, right?
So you would need, if you decide to buy it, you would need okay. and it was and you bought the strike price. It's strike price, right? Is that the
Right.
price you're
The
looking
strike
for?
price,
So
the
let's say you
strike
say you'll
price.
buy it at 60. So I'm
Uh-huh.
gonna need $6,000 in order to buy that, correct?
That's correct. That's
Okay,
correct.
so if you're buying the options, you still need that amount of money in your account, whether
That's
it's
correct.
margin or cash.
Correct.
Okay. And
Correct.
then now years ago when I first got into the stock market, the guy that got me into it, that's all he did was trade options. So he told me that so when that option is like Coca-Cola is at 57 and you buy the stock option, the call, right? Because if you're buying, it's a call. So
Right.
at 60 and the premium is only a fraction of that, right? You've got to put a fraction of that amount down. And
That's
that's how
correct.
much.
The premium, yeah, we're going now into the terms,
Okay.
but the important terms are the underlying, which is the object of the option. You're doing it on an option on Coca-Cola, for example, or it could be any stock or an index. Or so the underlying is an important concept or term. The strike price is the price at which the transaction happens. Okay, the premium is what the buyer pays the seller to have that option. And the
Oh,
maturity date is important. You can have a 1 month option, you can have a 6 month option, a 12-month option, you can have a 1 week option, depending on the maturity. They're all trading.
okay.
So today,
So,
yeah,
I'm sorry. I just want to see if I've got this down. So
all right,
we're talking Coca-Cola at 57. We'll just stick with that example because we've been talking about it. So
all right,
I buy a call option and say I want to buy this at $60. I think
right,
I think in 1 month it's going to go to $60. So a guy says, and you say, okay, I'm going to sell you this because it's running 57 right now. I'll sell it to you for 60. And
correct.
then, so in a month, it goes to 65. And I say, hey, I want to buy that. So I have to, now the premium, that's what I pay you for those shares. So if the premium, I believe was that like, if something's $57, it's like $5.70 for the block or something like that. It's like 10% of it.
No, 10% is too much for a 1 month option.
Okay.
10% would probably be appropriate if it was a 12-month option, because there is the time value in the option, and there's also the intrinsic value. The intrinsic value of the option is the difference between the strike price that you have the ability to buy the underlying at a specific price, and comparing it to the market price. So suppose it was a call option, and you're buying it with a strike price of 60 and it's trading at 57 now. The intrinsic value is zero, because you could buy it in the market at a cheaper price than what the option gives you the right to do. But if you have like 12 months into the future, then the time value is very large. So the premium on that option is probably $4 or $5, which is about 10% of the price. But if it's only a 1 month option, the premium will probably be around $1. So it's about 2% more or less of the
Okay.
price.
So if I were to buy that from you, this one contract, 100 shares, and I say in 60 days, I know this is going to $60. It's going up $3. So you would say that I would have to pay you, let's say it was that $2 was the premium. So I pay you
Mhm.
$2 for those shares. And then
No, you pay me $2 to have the option to buy,
I'm
and
sorry, that's
then
what I meant. So I
right,
would pay
and
you
then
$2 for that contract. It's basically like putting a down payment on it.
exactly,
And then
exactly.
it only
But
goes to,
then
if it only goes to 59 and I say, I don't want it. I'm out that $2 down payment that I gave you. No harm, no foul.
You lose the premium and I gain the premium. That's why I sell options, because I want to make money selling the options. And that's the thing. If it's at 59, you wouldn't want to buy it exercising the option, because you would have to buy it at 60 when it's trading at 59. And if you wanted to buy it at 59, you could buy it in the market instead of exercising the option.
But if it goes to 62, you've still got your $2 premium, and now I owe you $6,000 for those 100 shares.
Exactly. But then I would have to sell the stock to you at 60 when I know it's trading at 62, and I could sell it in the market at 62 if I didn't have the obligation of the option, you see. But I don't mind, because I got the $2 up front as a premium, so I'm breaking even, really. And you are too.
And I think that's the biggest thing when I was learning it. It was learning the different words, like strike price. That's the price you expect it to go to, whether it's up or down.
No, that's the price that you trade at, regardless of the market.
That's what I meant. The strike price would be like, if it's at 57, I think it's going to go to 60, and that's what I buy it. I put the contract with you at 60. That would be my strike price.
Exactly. So let's go about some of the other terms.
All right.
That it's good to understand. When a stock option is said to be at the money, that means that the strike price is exactly the same as the market price.
So both would be at 60 in our example. Okay.
In the example. So if it's the call option could be in the money, that means that the strike price is below the market in the case of a call option.
So it's at 59.
No.
No, it would be above 60.
It would be above 60, say 62.
It's in the money for me.
It's in the money for the buyer of the stock.
Yes.
Exactly.
Okay.
And if it's out of the money, it means it's below the strike price. The market price is below the strike price on the call option.
Say 59.
Or 57 now. So you will be buying an out of the money call. So the good thing about buying out of the money calls is that the premium is less than if you're buying it at the money, you see.
Okay.
So this is always good when you are selling, for example, covered calls. You have the stock and you sell calls. You're not going to sell the calls at exactly the market price at the money. You want to sell them a little bit higher, so that you do collect the premium if you're selling the calls, and the buyer of the calls is speculating that the price is going to go up, but they're putting out the premium to you. And then if it goes up, you have the stock and you just release them to the buyer. So those concepts are good. When you talk about puts, it's the other way around, right? So out of the money would be a put that has the market price above the strike, and in the money, the put would be below the strike price would be below the market. So all right.
So with that Coca-Cola example at 57 on a put,
so if
strike would be say 55.
55 exactly.
But if it goes up to 58, 59, you're out of the money and you're losing money. Or you just don't exercise the contract.
If you buy a put, that means that you are hedging against the price of the stock going down. Let's say you own Coca-Cola at 57 and you're concerned that the price is going to go down. And so you buy a put at 55. Okay, so if the price of Coca-Cola goes down, you lose money from 57 to 55, but after 55, you're protected.
Okay, so because you would have sold it at 55, and you're automatically going to get $55 for it.
Right.
Kind of like that. Okay.
Yeah, exactly.
Yeah, that's one of the things that I've always noticed with these options. videos that I watch. It's like they already assume somebody knows all the terms. Like I know very few of the terms. So like when you were saying the premium, it's like, okay, this guy makes this amount. He always gets the premium. And then once I equated that to as say a down payment, then I'm like, okay, well that makes sense. And then
Well, it's really not a down payment because that's not, if you pay the premium, that's not going to be part of your purchase price.
no, you still have to pay the 6,000.
Exactly,
Yep.
the entire amount, not
Yep.
the 6,000 less premium.
To me, it's almost like here's this amount of money to hold this for me. So
exactly,
I'll give you $5 if you hold that for me until a month from now. So
correct.
Okay.
So what are the strategies that we can do now that we know the terms? How do we play with this?
We got iron condors. Is that what we're talking? Iron condors.
Now we're not gonna go into condors or anything like that. So complicated.
I used to listen to Tasty Works or whatever it's called. Man, those guys, you just be confused. Just listen to their strategies. But
we want to get the basics straight so that you can then complicate it with the condors and the.
I like to take off running.
Yeah. So
right on my face.
Plain vanilla strategies. We've already talked about buying a call. Okay, you will do that to speculate that the price is going to go up, but you have to pay up the premium. So if the stock doesn't go up by an amount higher than the premium that you paid, in case and it doesn't go up to the strike price and beyond that by the premium that you pay, you're going to lose money. Okay, but if the stock shoots up like crazy, like like some of these meme stocks have done, you could make a lot of money if you're speculating there, or if you're just hedging. If, for example, if you buy a put, for example, you're speculating that the price is going to drop, or if you own the stock, you're hedging that your position is not going to lose value. So you also, when buying calls, you can leverage the purchase. For example, you control the block of 100 shares. And if it's in the case of Coca-Cola, you don't have to put up $5,700 for Coca-Cola. And instead you just put up, the $100 or so that the premium would cost you, because it's, the options are quoted in dollars, but you have to multiply it times 100 because it's 100 shares. So if you see a quote for a 1 month option of Coca-Cola for a strike of 60, and it says $1, that means it costs you $100. All right. So
to buy the shares.
So right. So normally the most common strategy out there is to write covered calls, which means if you own the stock of Coca-Cola, you have 200 shares of Coca-Cola, you might want to sell one put or sell one call of Coca-Cola at 60 and collect that $100 for 1 month. And most likely it's not going to be exercised. And if it does, that means that your $57 of Coca-Cola went up to 60. And so you made $300 right then and there. And then plus the additional 100 that you collected, you made $400. So you don't mind, giving out the shares because you made some money on it. Normally, most of the options will expire worthless. So the buyers are not going to make any money. The sellers are making the money. This is particularly true when you sell puts. And you normally should sell them on a cash secure basis, which means that you have the money in your account to pay for the options in case the price of the stock goes down. But traditionally, the stock market having the upward bias, normally the puts are never exercised because stock prices just continue to rise. But but you can lose money, with options, and that is a risk. In the case of buying the call, you can lose money because you lose the premium if the stock doesn't go up high enough. If you buy a put, you lose money if the stock keeps going up and you paid out the premium, right? The other way, if you're selling the call, you can lose money if you're selling a naked call and the stock takes off. You have to buy the stock in the market to sell it to the person at the strike price, the person that bought you the call, that paid for the call.
So the naked call, is that what you just said? A naked call? That's where you don't have the stocks? Because I've been hearing that. I've been hearing that term a lot with the like the AMC and the GameStop, and they keep talking about how these hedge funds are making, they call naked stocks or naked calls or naked, whatever it is they're doing, and that means they're basically selling naked shorts. They're selling, they're shorting a stock that they don't even own, which I always found, I was like, how can you short something you don't own?
That's exactly right. They can do it because the exchanges, if you have a margin account in the exchange and you have the stock in your exchange, the exchange actually lends the money out to people that want to short it. And so then if you have a naked short and you want to hedge that, you could buy a call to hedge. All right. So that's the thing. And the other negative thing about options is that you need a lot of capital, because like we said in Coca-Cola's example, the stock is trading at $57. And so to buy it, you would need $5,700, right?
Yeah. Yeah. So you're really, unless you used options with like penny stocks, you're not going to do options with $100, $200 in your account.
Right, exactly. In the case of SPY, which is the S&P 500 exchange traded fund, that's trading for $439. So if you sold a put on the index, and it went south, then you'd be on the hook for $43,000, $900. So, but even more in the case of Amazon is trading for $3,300, you would need in your account $300,000. So a lot of people don't have these amounts, and so options may be out of the reach for them, especially for the more expensive stocks. Coca-Cola is more manageable. It's a well-known company, it trades with volumes, and so. And so that's the thing, so if you have any other questions, you can drop us a comment, or if you want to discuss questions now.
Oh yeah. Well, I mean, I'm definitely going to have to talk with you about this more, because I've learned a little more, and it's becoming a little clearer to me. I don't think my account's ready for options yet, because I don't like messing with margin just yet. Yeah, that's basically like a loan from the brokerage company. So I'll pass on that one right now. But yeah, I've learned quite a bit just from right here, and you've managed to break some of the stuff down for me a lot better. And I'd be a little more comfortable starting to look into it, maybe start paper trading options on my Webull account or something, and learning how to do it.
That's the thing. My channel is about financial education. I want everybody to learn about stuff, even if they're not gonna use it, because do you really need to trade options to have to save for your retirement? Probably not. A lot of people just have their 401ks, and you can't do options in 401ks. So this is an interesting subject, and probably not for everybody. But if you have any questions, drop us a comment. We'll be happy to to address it. If you disagree or if you agree, you know, I would love to hear from you. And you can raise another point, you know, if you like. So always remember to subscribe, you know, and to
big thumbs up.
know that,
Thumbs up for that
yeah.
YouTube algorithm.
Yes, yes.
I just like to add, if you have questions
yeah.
about options, yeah, that I don't know if I'm pointing in the right direction, but on my screen, I'm pointing at you. Go to Finance ABCs because I know nothing about them.
Well, everybody learns every day, and if you think I know a lot about options, it's because I've made a lot of mistakes with options and I've lost some money with them.
Oh yeah.
So, but you learn, you live and learn, and so you know, by all means, ask the questions. So,
yep.
All right. So there we have it.
Yeah.
Should we?
I mean, unless you have anything else to add, because
no,
I'm just trying to figure out the basics with options. So I could be asking you just basic questions all day long, but nobody wants to watch me just ramble on, and they're probably yelling at their screen now saying, just wrap it up. So
yeah,
but,
let's not make the video too long.
Yeah.
All right. So let's cut it short now, and then we'll do another one sometime.
Oh yeah, we'll definitely have to do another one. This, you know, these are fun. I like doing these now. So, all right. So I'm going to wrap this up. Hey, everybody, thanks for watching. Like I said, give us a big thumbs up for that YouTube algorithm. Go over and check out Guillermo's channel on Finance ABCs. I'll leave a link to his channel down below. And all right, everybody, have a great day. Thanks. Bye.